Hi friends, so let's now move to the next chapter on theory discussion, which is on advanced capital budgeting decision. Let me first set the context of the chapter. So in capital budgeting, what we are going to learn is, you would have learned capital budgeting at CA Inter, where focus would have been on investment decision. That is, when should an organization do an investment? That would have been the focus area at that time. We also had an element of risk analysis in capital budgeting, but that was not done in detail. So here in the theory segment, because the practical segment is already discussed, in the theory segment, we're going to first initially see that whenever an investment is done by an organization, what are the various factors which can impact an investment decision? The some of the factors which ICI material discusses about are inflation. How is the impact of inflation on a capital budgeting decision? I think technology, that's another factor which we are analyzing. Government decisions, and then we go ahead and see the various techniques which are there to incorporate risk in a capital budgeting decision. What are the various factors which are there to incorporate risks? You can broadly classify them into the various techniques which are there. Like you have techniques like probability, standard deviation, expected value, RADR approach, risk adjusted discount rate, certainty equivalent approach, sensitivity analysis, scenario analysis, simulation analysis. That's a broad overview of the chapter. Focus now is to discuss on the theory component. The practical component is already discussed by us when we were doing the problems. So let's first start with the question 1. What is the impact of inflation on capital budgeting decision? Now, the term inflation basically mean the rise in prices. So, when there is a rise in prices happening, when there is a rise in rates which are happening in the practical world, it has an impact on both revenues as well as cost. So, what we can do is, the revenues are the cash flows of a company. Whatever cash flows a company is generating, it can be disclosed in two forms. One is your nominal terms. We have something called as nominal terms. Just give me a minute. We have cash flows which are in nominal terms, and we have cash flows which are in real terms. Nominal terms means incorporates the impact of inflation. Real term means the inflation impact is removed. What we learned is this will be discounted at nominal discount rate, or also called as money discount rate, and this will be discounted at real discount rate. Discounted at real discount rate. That is what we learned as far as the real term part is concerned. So what we are trying to do here is, inflation basically means the rise in prices. So it's very critical for an organization to consider this in their capital budgeting decision, because this is going to impact the revenues, will raise the revenues and cost of the project. If you eliminate the impact of inflation, the net revenues after adjustment for inflation shall be equal to what is the revenue in current terms. Current terms means current rate, which is basically called real cash flow. That will be technically called real cash flow. One issue is, on your capital investment, the depreciation which we charge does not get the benefit of inflation, because depreciation is always on historical cost. So as inflation increases, the benefit, what is the benefit is, on depreciation we get tax benefit. The worth of the tax benefit will start going down in case there is a continuous increase in inflation. So inflation impacts the benefit which we get from the depreciation. Also, whatever cost of capital an organization is considering, in the cost of capital, that is the discount rate, it is critical that we contain a premium, we include a premium for the anticipated inflation. In simple words, whatever discount rate an organization is using, that discount rate should be real discount rate plus the impact of inflation. In fact, we had a formula, all this you would have learnt in theory part, which is 1 plus money discount rate is equal to 1 plus inflation rate into 1 plus real discount rate. So we'll have to consider the impact of inflation in the discount rate computation. So that's the impact of inflation on capital budgeting decision. Next, what is the impact of change in technology on capital budgeting decision? Now, changes in technology is a very, what to say, it's a very critical factor, but a very difficult factor to consider in a capital budgeting decision. Because normally what happens is our focus when capital budgeting is always on monetary items. Technology as an item, it could be difficult sometimes to consider the impact. Capital budgeting often focuses on monetary terms, neglecting critical factors like technology. Because our focus is mostly on the monetary item, we end up ignoring these critical factors like the technology which is there. So then what is the organization required to do here? An organization should always evaluate how technology is going to impact a technology can impact my revenues, it can impact my costs, and in the end it can also lead to abandonment of project. Abandonment is giving up the project. I go ahead and give up the existing project because the continuous changes in technology has now made the product which I am manufacturing as an unviable project, because the continuous changes in technology has a significant impact on my operation. So as an organization, it's critical that we continuously evaluate what is happening in the external market space, because if there is an improvement in the technology or there is another way of doing our manufacturing process, it is good to adopt the new technology so that though we incur extra expense, our cost structure can come down significantly. So analyzing the impact is crucial for understanding future cash flow and also determining the need for replacing the machinery with improved technology. You can go ahead and change the existing machinery with an improved technology. What and all changes can be brought in? It can significantly alter your production process. That is, it changes the way we have been doing things. Just to give an example, accounting as a concept, if you take 10 years back, or not 10 years, maybe 20, 30 years back, the accounting used to be done manually. People were writing journal, then ledger posting was done, then trial balance was prepared. But because of the technological changes, Tally as a software, moment you record the journal, everything else is automatically taken care of. The changes can give you benefit like improved quality, improved delivery time, greater flexibility. All this can lead to these two items. Improved cash flows will be achieved through your technological changes, and because you are doing this improvement, be ready to spend a little bit extra, because extra spending is critical. Because if I do capital expenditure, this capital expenditure is an extra cost, but that gives me benefits like improved quality, delivery time, greater flexibility. uh, how do I incorporate this risk in my capital budgeting decision? Now, I should first continuously evaluate, is there a need? Is there a need for changing my machinery, for changing my production process, for changing the manner I'm operating? Is there a need to do any alteration first? Is there a need to alter my production process, or not only the production process, there could be a need to alter the machinery which is being used by the organization or the softwares which are being used by an organization. So an organization should always consider positive and the negative impact, positive and the negative impact. And as I said earlier, in case things are not working well, it may be a time to put a full stop. That is, things are not working well for us, so I will go ahead and put a full stop. What is full stop? Is considering abandonment option. I will try to consider an abandonment option because things are not working well. If after trying a lot, if things are not working well, it could be that we try to put a full stop, saying that I let me abandon the project at this stage. Also, I can factor this through various techniques like your sensitivity analysis, where you analyze a change in one variable, scenario analysis where we analyze changes in multiple variable, and simulation analysis where we run the model and understand what is the impact. So technology is kind of an intangible factor, but it can impact your revenues, cost, and in the end it can even lead to abandonment of a project. How do you factor this? You can factor this through various techniques like scenario analysis, sensitivity analysis, or your simulation analysis. Next, write a short note on impact of changes in government policies on capital budgeting decision. Now, the government policy can impact a domestic capital budgeting decision. It can also impact an international capital budgeting decision. Government policy is very, very critical because your domestic capital budgeting decision as well as your international capital budgeting decision are significantly impacted in case of changes in government policies. And government can make changes through multiple ways. There are long term policies which government implement. There are also short term or medium term policy like RBI releases a monetary policy every whatever is the time period they decide. There is a meeting every month. There will be some revision in interest rates. Fiscal policy of the government will be introducing the fiscal policy or through the budget where tax rates are determined. Any changes in the government policy like interest rates or tax rates or the stance of the government or new subsidies introduced, all these is going to impact my cash flow. All these are going to impact my cash flow. In the domestic side, I'm impacted by the government actions here. When I do an international capital budgeting problem, we'll have to factor in the risk which is there for the government decisions taken by that government. Also, if at all any restrictions are brought in my respective government also. Government policies significantly impact capital budgeting decision as they affect future cash flows for firm. These policies can impact my supplier, buyer, customer, service provider, and as I said in technology, in case you are not analyzing this properly, because what can happen is it can also lead to abandoning projects if necessary. That is, if things are not working well from the government side, if government is putting in a lot of restrictions. Example, I am into plastic manufacturing. The stance of the government is very clear that they want to eliminate the usage of plastic to a great extent. They want to keep bringing it down. If that's the stance of the government, it may be a time for me to abandon this project of plastic manufacturing and move to some other business, because the stance of the government is very clear. They don't want to promote this product. Government policy changes can impact both domestic and international capital budgeting decision. The change can be over time, which is 5 to 10 years. Also, it can be quarterly to a year, because I can have a long-term policy. I can also have a short-term policy. Some of the short-term policies which are reviewed within a year: fiscal policy and monetary policy. Fiscal policy is basically the budget announcement, where the government releases data on government spending, taxation, and borrowing to influence the economic activity and growth within the country. And monetary policy, where they are trying to promote economic growth, price stability, and balance of payment through what? Regulating the money and credit availability. Primarily, monetary policies through RBI, where the interest rates in the country are determined. The focus is on determining the interest rates in the country. That is what you try to do through monetary policy. Fiscal policy is focusing on the taxation side. Both obviously will have an impact on my cash flows and discount rate. Interest rates go up, the discounting rate will change, and in case there is changes in tax rates, that is going to obviously impact my cash flows. Okay, the next one is just an extension of the changes in technology discussion, where we are focusing primarily on the domestic capital budgeting decision. Then I think there is one discussion on international capital budgeting decision. The domestic part, again, the focus is on monetary policy as well as the fiscal policy. In the monetary policy, there can be revision in interest rates. So when there is a revision in interest rates, it is going to impact my cost of capital. When there is an impact on cost of capital, the capital budgeting decision may get impacted. That is because you're increasing or reducing the discount rate. It can lead to acceptance or rejection of a project, which was earlier the opposite. Earlier you were accepting, but now it gets rejected, or earlier you were rejecting, but now it gets accepted. Also, this significantly impacts, but when interest rates start going up or going down, it will impact my working capital decision. Because what happens in the working capital side is the availability of money is very critical, and if interest rates are significantly going up, I may have to take a call as to how do I manage the working capital requirement. And what also is, if there is a small change, I can kind of ignore. When I say ignore, the impact may not be that much. But when there is a significant change, it is going to have a lot of impact on my decision making. So a significant change is a big problem. A small change can kind of be ignored. Fiscal policy, additionally, your changes which are happening in fiscal policy, like your tax rates, our annual cash flows, all this will require risk estimation. The tax rates part, whenever there are changes in tax rates, because of which the cash flows may have to be revised. How does it impact international capital budgeting? When we do international capital budgeting problem, the focus is getting the cash flows in my home currency, because I'll be making my investment in a foreign currency. I'll have to convert that into my own currency. When I'm converting that into my own currency, exchange rate is very critical, and the exchange rate is determined on the basis of interest rate parity theory. IRPT plays a significant part on the estimation of IRPT is going to play a significant part on the estimation of your interest exchange rates. So, foreign policy play a crucial role in international capital budgeting. Changes in your bank rates and money supply may require revision of estimates, because one, it will have impact on the future exchange rates, and it can also impact my project which is going on in that country. Changes in tax rates, which is your fiscal policy, that can also impact my cash flow. Here, not only the tax rates which a country is determining in the which is determined in India, it may also be because of the DTAA provision. So you'll also have to look at what is there in the double taxation avoidance agreement. that will also lead to revision of estimation. The very important point is every organization should somehow factor this in their decision making, and they should go for proper forecasting of what are the likely changes which are going to be there. So forecasting the policy changes and incorporating proper revisions are crucial. Now, whatever 5 questions I've discussed till now, all of that was trying to measure the impact of changes in various items. What are the items? We looked at technology. How does technology impact my decision making? How does inflation impact my decision making? How does government policy impact my decision making? So the focus is primarily on the risk angle. The focus is how are these changes going to impact my decision making. Primarily this angle is called risk angle, where we now come to the next question. What is risk? What is uncertainty? Now, risk is a situation, though we keep using these terms interchangeably in a practical world, these terms can be used interchangeably, but risk is basically a situation where several outcomes are possible. That is, when you do a project, you can get 10,000 rupees profit, 20,000 rupees profit, 30,000 rupees profit, 40,000 profit, 50,000. Several outcomes are possible. Within that, you are sure that one of the outcome will happen. Within that, we are sure that one outcome can occur, and you attach probability to this. So if you're able to attach probability to various outcomes, then for example, we did this NPV probability. I'm attaching probability, get a product, get a deviation, get a PD square. So automatically risk can get measured through the help of standard deviation. Uncertainty is somewhere where you cannot tell what are the range of outcomes which are there. I cannot exactly tell what are the various possibilities. Even I cannot make a best estimate of what can be the various outcome. Obviously, if you don't know the outcome, the probability cannot be ascertained. So risk is something which can be measured. Uncertainty is something which cannot be measured by an organization. Now, our focus in capital budgeting is only on the risk side. I'm not looking at the uncertainty side, because uncertainty as such cannot be measured. Risk is something which I can measure and then try to take a call on balancing the risk or managing the risk. Now, why is risk required to be adjusted in capital budgeting decision? Now, you have told that risk is critical to be incorporated. Understood. Why should I worry about risk? Now, risk adjustment is very critical because I have 20 projects to be done. Let's assume a company has 20 projects to be done. If you just go by normal capital budgeting decision, you focus on the maximum NPV. You focus on the maximum NPV. Now, you know that investing in stock market will give you higher returns than investing in a bank fixed deposit. A bank FD can give you 6% interest or a 7% interest. A stock market investment will give you 12% return or a 14% return or a 16% return. But still, both are not comparable because of the risk angle. So when you have 20 different projects to be done, in order to prioritize the project, somewhere the element of risk needs to be considered in my decision making. There is an opportunity cost involved while investing in a project for the level of risk. Adjustment is necessary to make the decision as to whether the stock market returns which are being generated, is it commensurate with the risk being undertaken? Returns are proportionate with the risks borne, and whether it is worth investing in the project. Risk adjustment will give me the real value of the cash inflow. One of the technique of risk adjustment which you would have learnt is risk adjusted discount rate, where we are saying You cannot use the same discount rate for different projects. The discount rate for project 1 is going to be different vis-a-vis the discount rate for project 2. The reason for different discount rate is we believe the risks are different. When risks are different, obviously you will have to use different discount rate. What are the various sources of risk? Now, various sources of risk is where does the risk come from? Broadly, you can classify them into internal factors and external factors. Internal factors are somewhere within the control of the organization, which is specific to a company. External factors are beyond the control of an organization. These internal factors are like unsystematic risk specific to the company. They are specific to the company or the project. External factors are like systematic risk. Systematic risk, you learn about this in portfolio chapter, that the risk can be systematic risk or unsystematic risk. So internal factors are specific to a company, which are like unsystematic risk. You would have learnt there broadly business risk and financial risk. External factors are systematic risk, which is going to impact every company. In the internal factors, that is that business risk and financial risk. What is business risk? Is the factors which are impacting my business. Financial risk is debt, equity mix and other factors. This here we classified as project specific risk and company specific risk. That is, I am doing a specific project. In the project, what can happen? Whether the project will get over in the scheduled time or not. If it's not getting over in the scheduled time, there is going to be an impact on my cash flow. Error of estimation in resources and allocation, error in estimation of cash flows. Company specific risk, risks which are to company factor, not specific to the project but specific to the company. A company may be doing 10 different projects. L&T could be doing 10 different projects, and if there is some legal case put against L&T, it is going to impact L&T as well as that project which is be going on. So like downgrading of credit rating, changes in the key managerial personnel, that is the MD has changed, our CFO is changing, CEO is changing, cases for violation, other laws, dispute with workers, all that is going to impact L&T as well as a specific project of L&T. Now, external factors are something which are kind of beyond the control, but obviously this is also going to impact me. The first one is in external factors, you can broadly call external factors as EI. That is basically called EIC analysis, which you learn in another chapter. EIC analysis, in that C is called company factors, E is economy, E is the economy factors, and I is the industrial factor. Industry, economy, industry and company. In that company factor, in the EIC part, the company factors are analyzed as part of internal. Economy and industry. What is economy and industry? The first one, industry specific risk. These are the factors which are going to affect the whole industry, which can be some restrictions which government brought in. For example, telecom industry. In the telecom industry, there are a lot of restrictions from the government side on various factors. If government brings in extra restriction, that can again impact the industry as a whole. The government can suddenly say that you cannot charge beyond a specific price, or on the mobile number portability. That is a factor which they brought in, which led to a lot of service improvements for customer, but that's an important decision taken by them. Market risk. What is market risk? Is again related to the industry. You can analyze market risk from the point of view of few specific factors on Porter's 5 forces model. Porter's 5 forces model. That is, in Porter's 5 forces model, you are focusing on bargaining power of customer, bargaining power of supplier, the entry of substitute, entry of new competitor, market related condition like entry of substitute, changes in the demand condition, availability and access to resources. An extension of Porter's five forces model is competition risk. Example, again I take the telecom industry, where moment Jio came in, Reliance Jio came into the industry, it impacted significantly. It had a significant impact on the entire industry. These are risks related with competition in the market in which a company operates. These risks are due to entry of rival, product dynamism, and changes in taste and preference of consumers. I said EIC, economy, industry, and company. Company we saw earlier, industry we have discussed, economy, risks due to economic condition. These are macroeconomic condition. What are the macroeconomic condition you can think about? That is government bringing in some new taxes, which is fiscal policy changes, or the monetary policy changes, by which on the overall economy the growth changes. GDP growth is one macroeconomic factor. Unemployment rates, poverty rates, per capita income, all this is going to impact my fact or my project. And in case the project which I am doing has some international transaction, that is, it could have some import transaction or export transaction. If you have any import transaction, export transaction, foreign currency financing, or foreign currency investment, then you're also impacted by the global economic condition. The global economic condition will impact in case there are imports, exports, global financing, or global investments being done by an organization. Okay, next question is various tools available for incorporating risk and capital budgeting. This is what I think, this is just a broad overview of the different types of questions we have solved. One is the statistical technique, where we have probability, variance or standard deviation, and coefficient of variation. Conventional techniques, statistical technique is working with those numbers. Conventional technique, we had RADR approach and the certainty equivalent approach. And the newer techniques which have come, which is sensitivity analysis, scenario analysis, simulation analysis, and I think this is there's an error there, decision tree. It should be called decision tree. It's not simulation tree, it is decision tree. So these are the various techniques which are available for incorporating risk, for the incorporation of a risk in a capital budgeting problem. In that, what we were doing for probabilities, the historical data was given. So you will have NPV, probability, product, deviation, and PD square. The sum of the product was called expected NPV. The square root of PD square, the overall PD square was called variance. The square root was called standard deviation. Coefficient of variation is risk per unit of return. Risk per unit of return. So risk is the numerator, which is standard deviation. Return is the denominator, which is NPV. Because there is no separate question on the statistical technique, because we have discussed this in the practical portion. On the conventional technique, we have certain theory questions, because every technique, one, it'll explain what is a technique, and then we have to discuss what are the advantages and disadvantages of the technique. So that is why the theory component is there for the conventional technique. First technique is RADR. RADR is very simple. What RADR approach says is use different discount rates for different projects depending on the risk of a project. Use different discount rates for different project depending on the risk of a project. If a project carries high risk, evaluate it at a higher discount rate, and if it carries less risk, evaluate it at a lower discount rate. The project with a higher risk will be discounted at higher rate, and the project with a lower discount rate or lower risk will be evaluated at a lower. The basic formula is risk-free rate plus risk premium, or you can extend the formula as 1 plus risky rate, because percentages cannot be added, is equal to 1 plus risk-free rate into 1 plus risk premium. Practical world, this is a technique which is significantly used. Reason is very simple, because I make it very easy to do this. It is easy to incorporate the risk premium. It's easy to incorporate the risk premium because the other technique available is certainty equivalent factor, where you will have to adjust the cash flows. Adjusting the cash flows is a slightly difficult option as compared to adjusting the discount rate. So in the practical world, RADR is the preferred approach because it's easy to adjust the discount rate and incorporate that in the discounting factor. Limitation is difficulty in finding this risk premium. So it is easy to incorporate this in the when from a computation point of view or from a discussion point of view. It's easy to incorporate, but how do I find out the risk premium? There are few options available. One of the option available is if you can decide what is the beta of that project. If you have high beta, high risk premium, low beta, low risk premium. And also, if you are using the RADR approach cannot be used to calculate standard deviation of a project. But again, I don't see this to be a main limitation because standard deviation is one way of factoring the risk in a project, and this is another way of factoring the risk in a project. So why do I need two techniques to factor the risk in a project? Let me go through the RADR technique, which can obviously factor the risk in my project. Then what is certainty equivalent approach? What is certainty equivalent approach says is every year whatever cash flows we are generating, we can attach a certainty equivalent factor to every cash flow. Once the certainty equivalent factor is added in every year cash flow, I can convert the uncertain cash flow into a certain cash flow. We can convert the uncertain cash flow into a certain cash flow. An approach to dealing with risk in a capital budgeting context, it involves expressing the risky future cash flow because the future is uncertain to some extent, so it is called risky. In terms of a certain cash flow, you will convert the uncertain cash flow into a certain cash flow. We used to have a formula, the certain cash flow is equal to uncertain cash flow into certainty equivalent factor, converting the uncertain cash flow into certain cash flow using a certainty equivalent factor. That is the decision maker. What they are saying is getting 1 lakh risky cash flow is equal to getting 80,000 riskless cash flow. I am indifferent between the risky amount and the lower riskless amount. So what we are trying to do is here we are adjusting the cash flows. Once you do this adjustment, you should discount, because discounting is done to affect time value of money, but discounting should be done at risk-free rate. Discounting should be done at risk-free rate. Is a guaranteed return that the management would accept rather than accepting a higher but uncertain return. The higher is an uncertain element. So when we have an uncertain element, I am saying let me factor in this where I am getting a set of riskless cash flow. I am getting a set of riskless cash flow. Now, what are the advantages? Is RADR basically says I'll adjust the discount rate once, and indirectly when you adjust the discount rate once, you are using the same discount rate for first year cash flow, second year cash flow, third year cash flow, fourth year, which indirectly means we are saying the same risk is there for every year cash flow. The risk is same for every year cash flow, whereas different risk can be applicable for different cash flow for different years. First year cash flow could be relatively lesser risky. Second year, third year, the risk will keep going up. In a particular year, a higher risk is associated. It can be easily adjusted. That adjustment is possible in certainty equivalent approach. Practical world, CEF approach is still not used a lot because it's difficult to ascertain the CEF factor for every year. There's no objective or a mathematical method to ascertain certainty equivalent because they are subjective in nature. When it comes to your RADR, the risk premium part can be ascertained through beta or through the risk index formula or linking it through coefficient of variation. We did one problem where linking it through coefficient of variation, we were deciding the RADR. But here most of the time it's a subjective factor, and based on the perception of the risk, whatever is the perception of the risk. So that is why what happens is, because of the subjective element which is being brought in the CEF approach, practical world, this is not which is predominantly used. Certainty equivalents are decided based on the perception of the risk. That is what management feels. Whatever is the risk perception of the shareholders, again you are ignoring them. Whatever management believes is the risk perception of the project, that is considered in analysis. But a shareholder may have risk not only because of the project. If you are borrowing extensively, that is also impacted. Hence, this is not often used in corporate decision making. What are the key differences between RADR approach and CEF approach? Basic thing is very simple. RADR approach adjusts the discount rate. CEF approach adjusts the cash flow. It adjusts the cash flow. RADR looks at single risk rate. That is, you adjust the discount rate once and use the same risk rate or same discount rate for different year cash flow. Whereas the CEF approach can have varying level of risks for different years, is superior to RADR approach as it does not assume that risk increases at constant rate. You can have every year different discount rate. What is risk increasing with every year is, if you use 12% as a risk rate, 1 divided by 1.12 first year. Second year, if you divide by 1.12, the PVF factors keeps going down significantly, which means you are assuming that uniform level of risk is there for different year. Whereas in CEF approach, I can alter this. First year, I can use 0.9 as CEF, second year 0.7, third year 0.8, fourth year 0.6, fifth year 0.9. You can change the CEF factors despite its soundness. Despite its soundness, that is, CEF approach is better. It's not preferable. It is not preferable because it's difficult to specify a series of certainty equivalent coefficient. Explain the concept of sensitivity analysis. Now, what is sensitivity analysis? Very simple. Whenever we are doing a project, the project may generate positive NPV or negative NPV, but this NPV can change based on selling price and change based on cost price, units sold, initial investment, life of a project, discount rate. So there are multiple factors which can impact the NPV of a project. Favorable impact, adverse impact can be there. In sensitivity analysis, we normally try to assess variation of a single factor. We are just looking at single factor. When that changes, how is the viability of project changes? When there is a change in selling price, a favorable project may become an adverse project. When there's a change in cost price, when there's a change in life, when there's a change in discount rate. So what is the impact on the project? Sensitivity analysis is used in capital budgeting to study the impact of changes in variable. Normally we assume only variable adverse changes. Sensitivity analysis studies the impact of a single variable, only single variable. Scenario analysis analyzes the impact of multiple variables. It analyzes the impact of multiple variables. This analyzes the impact of only single variable. What is the objective is to identify what is the most sensitive or the critical factor. Identifying the most sensitive or the critical factor for the project success. Lot of the things which I'm discussing now will become clearer only for you if you have gone through the practical angle. That is the practical problem solving. So that is why I normally keep theory in the end, because once you discuss the practical component, the theory component becomes simpler. So it helps me in identifying the critical issue and simple technique. The only biggest trouble with sensitivity analysis is single factor at a time. That is, it assumes all variables are independent. For example, selling price reduces from what I had planned. then in my sensitivity analysis, I cannot increase the unit sold, because when selling price goes down, there's a possibility of increase in units sold. It assumes all variables are independent. Variable one will change, other variables will remain same. So that is why the problem comes in. It also does not factor the probability part and all. That is there any, how much is the probability of the change which is going to be there? But the biggest trouble is only considering single variable change, assuming that all variables are independent in nature, whereas they are not independent in nature. When one changes, others will automatically. For example, I want to increase my initial outflow because I'm buying an advanced machinery. If you buy an advanced machinery, there's a possibility that in between flow, the cost can go down. The initial outflow can increase, but in between cost can go down. Now that is where scenario analysis came into picture. Sensitivity analysis is normally the most widely used method, but it does have limitation. The limitation is because it is considering single factor. It is considering single factor, and it also ignores the impact of, is that the probability, how much is the probability of that change happening. It would be useful to vary more than one variable at a time so that we could see the combined effect of changes in the variable. Scenario analysis tries to do this, considering multiple changes at a time. When you consider multiple changes at a time, it is possible that we consider some of them as positive changes and some of them could be adverse changes, because when you're considering multiple factors at a time, it's good to see some positive changes and some negative changes. So the analysis helps in the probability of changes in key variables and allows us to change more than one variable at a time. More than one variable at a time is very critical. It can also help us in one, the base case you start and then go for the changes which are there. You can try to bring in multiple changes, some positive, some negative, worst case scenario and best case scenario. Main differences between sensitivity and scenario is kind of discussed. Main variation is very simple. Sensitivity analysis works on single input variable. Scenario analysis works on multiple input variable. So technically scenario analysis is more complex than the sensitivity analysis. Write short notes on Monte Carlo simulation. Simulation is basically used for doing infinite calculation. That is, once I decide a model of a project which is being done. What is model of a project is using the past data. If you can decide what are the parameters and what are the variables. Parameters are something which are not going to change. Variables are those which can change, like selling price, cost per unit, units sold, initial outflow, life of a project. So there are few factors which can change and there are factors which may not change. So if there are factors which are likely to undergo changes, I want to do infinite calculations for them. I want to do infinite calculations. I can go through Monte Carlo simulation based on casino gambling mathematics provides with a probability distribution of expected NPV. It involves modeling the investment projects, that is cash flows and key factors, using a probability distribution. The best part of Monte Carlo simulation is it can handle in complex projects. It can handle in complex projects, complex interrelationship. But again, there are a lot of challenges which are there when you get into your the Monte Carlo simulation. Has several limitations, including difficulty modeling project and specifying the probability distribution. What is exogenous variables? Variables which are likely to undergo a change. So it's difficult for me to decide the probability distribution. Also, it is not perfect. It is imprecise because it will just give you rough approximation. Many a times what will happen is when you are trying to do NPV in simulation, you are using risk-free discount rate. You are using risk-free discount rate. But the point is, in the practical world, you cannot use risk-free discount rate for evaluating a project. A project evaluation cannot happen on the basis of a risk-free discount rate, because real NPV depends on the risky discount rate. So whatever average you derive is takes a different meaning from its original value, and therefore it is difficult to interpret. One is deciding the probability distribution is very difficult. Whatever outcome which comes, it may not be perfect, and also you are using risk-free discount rate. When we are using risk-free discount rate, whatever answer we are getting, that may not be the right NPV, because calculating NPV on the basis of RADR or on the basis of risky discount rate is the right NPV. Brief overview of decision tree analysis. Decision tree analysis is useful when you have to do sequential decision making. What is sequential decision making is, you start whether should I invest 1 lakh today or not. That's the decision you're taking. Once you took that decision, depending on success or a failure of the project, you have to take a second decision, you have to take a third decision, fourth decision. So decision tree is useful to handle sequential investment decision, where there are two elements. One, there is a decision, and second, there is an event. Decision is basically a factor where I have control. Decision, I try to put it through a rectangle, and we have two branches coming from it. We take higher of the value. Because you can decide in which branch you want to travel. Whereas event is denoted by a circle where the branches will have probability, and we take a weighted average. So this is very useful for sequential decision making. When you do sequential decision making, can I do it without a decision tree? Yes, possible, but it becomes difficult to work without a decision tree. So just to summarize now what we did in this area, we first started with what are the factors which are going to impact risk of a project, where we broadly saw inflation, technology, and government decision. Inflation is going to impact the power of money, is going to impact the value of money. So it can impact my revenues, it can impact my cash flow. Depreciation part does not get extra benefit, or the impact of inflation is not there on depreciation. So the benefit arising from depreciation will keep going down as time passes by. In the discount rate, we should consider the normal rate plus the rate of inflation. How does technology impact? Technology can lead to variation in my revenues, variation in my cash flows, variation in my cost, variation in my initial investment, and it can also lead to abandonment of a project. You may end up doing abandonment of a project. So it's very critical that I see what is the impact of changes in technology. It can alter my production process, it can improve quality, delivery time. How do we factor this? We factor this through sensitivity analysis, scenario analysis, simulation analysis, and at some stage decide whether you want to abandon the project. Next is government policy, which is primarily fiscal policy, which is tax rates related stuff, or the budget, and the monetary policy, which is related to money supply, which can impact a domestic capital budgeting decision as well as an international capital budgeting decision. Risk is something which can be measured, uncertainty is something which cannot be measured. Why is it necessary to adjust risk? Because I have limited money. I need to put the money in those projects which are giving the return which is commensurate with the risk being undertaken. If you take high risk, I want high return. If you take less risk, I want to get lower return. What are the various sources of risk? Internal risk, which is unsystematic element, which is project specific and company specific. External risk, which is systematic, which is economy or the industry related, that is industry specific, market risk, competition, economy related, macroeconomic factors which needs to be brought into our analysis. Various tools, we have statistical technique where probability, standard deviation, and coefficient of variation, conventional RADR and CEF approach, and the newer techniques like sensitivity, scenario, simulation, and decision tree. How do you evaluate a project using RADR? RADR is normal discount rate plus the risk premium. Easy to understand, simple to compute. but the problem with this approach is there can be a difficulty in identifying this what should be the risk premium, and it cannot be used to compute standard deviation. I don't see both to be a major issue. Certainty equivalent factor is an approach where we adjust the cash flows every year. We convert the uncertain cash flow into certain cash flow. Technically, it's a more sound method. It's a very good method because it can allow us in incorporating different risks for different years. But again, not used because there's a lot of subjective element which is there. You are not very sure what should be the certainty equivalent. So there is a lot of objective or the subjective element is there. I cannot have an objective method of deciding what should be the certainty equivalent. Differences between CEF approach and the RADR approach. In the CEF approach, we are adjusting the cash flow. RADR approach, we are adjusting the discount rate. CEF is considered to be a superior approach, but still not used much in the practical world. Sensitivity analysis is very simple, where we are trying to find the impact of changes in one variable. So identifies which is the most important variable. Simple technique. Problem is only one variable you are assuming. So you're assuming that they are independent in nature. That is, change in one variable will not impact the other changes. That is where we got into something called a scenario analysis, where we are trying to factor in multiple variable changes at a time. Also consider the impact of probability. Then came the Monte Carlo simulation, where we are trying to develop infinite calculations by developing a model of probability distribution. You will develop a model of probability distribution for every variable which is likely to change, like cash flows, revenues, cost. Decide a probability distribution for that, and then fit in random numbers and run multiple exercises. You can run, in class we would have done 10 experiments, but you can run 100 experiments, 1000 experiments, 10,000 experiments. That will finally decide what is the likely NPV for various experiment, and you can decide a probability. The major disadvantage is, one, deciding this probability data or developing the model itself, and you are using risk-free rates for discounting, which may not be the right way of doing it. And next is decision tree analysis. In decision tree analysis, what we are trying to do is, we are trying to do sequential investment decision making. Sequential is taking one decision. If you take the first decision, what is the second decision, or what is the third decision? It can go into different branches, where we have decision node and chance node. Decision node is somewhere I have control, I take the higher of the value. Chance node, where I don't have control, I take the weighted average of the various branches which are coming out of it. This takes care of this chapter. If there are doubts, you can just message me. Thank you, friends.